Welcome back, everyone, and thank you for joining me for another episode of the Midtown View. I'm Jim Wenk, and I'm joined here by Pierre Debbas, co-managing partner of Romer Debbas, a leading law firm here in New York, representing both buyers and sellers on residential real estate transactions. Pierre, welcome to the show.
Thanks for having me, Jim.
Thank you. We were talking earlier that 2025 is slated to be a very dynamic year in the market. 2024, I think people feel a general sense of optimism, especially towards the end of the year. Mm-hmm. But would love to hear from your perspective how your clients, both buyers and sellers, are seeing the marketplace, as we start the year anew.
Yeah, there's still trepidation in the market, but I will tell you, we ended last year on a positive note. I think the last 2 months of the year in general had a big uptick in demand. And we're seeing that, sentiment continue into this year, which is really reassuring. But in reality, people are still skittish, right? Like what is pushing people to get off the sidelines today, right? Pricing's not adjusting much. Our hopes of significant rate cuts keep, dwindling down, I think, with every month that passes. And the uncertainty still exists. At the end of the day, though, we've been in a somewhat of a stagnant market for 3 years. Ever since the Federal Reserve started, increasing rates aggressively in June of 2022, it has created a stagnant market in most segments of real estate. At some point, people have to transact, right? There's only so much money you can have on the sidelines. In terms of housing, people have to move. There is an element of, you're forced to, relocate at some point. So, but where we do prosper as an industry is the discretionary moving, right? Let me upgrade, let me buy a second home, let me buy an investment property. And that demographic is starting to pick up a little bit, which is a good sign for sentiment this year.
So whether it's on the secondary home purchase or an investment property, as rates came down a bit, right, last year, but we're not quite as optimistic on rate cuts going into this year. Are you seeing lenders wanting more equity being put into the deals? Do you see that changing a bit? Because we know obviously there's been more equity that has to be put into these transactions than previous, but we'd love to see we'd love to hear what you're seeing on that end.
Loan to value ratios haven't changed that significantly in the last 2 years. People are putting down more equity largely because the debt service is so high given where rates went, right? So, in order to manage your monthly expenses, people are traditionally, or I guess, subconsciously putting more down. But in terms of lending, I'm not seeing banks too concerned with that because valuations have maintained steady. Conventional wisdom would lead you to believe that if rates go, triple in the course of 18 months, that would have an adverse impact in property values. Crazy thing is, it's not just, for Manhattan, the country, prices have actually gone up single digits because it's not just a fact of rates plummeting, the demand. There's such a shortage of supply that even with demand reduced by half, we're still short supply for current demand levels. What does that mean? It means pricing staying pretty steady, if not appreciating.
Do you think that one of the factors for a lack of supply is this newest wave of buyers, whether it's people in their 30s, 40s, that they're looking for a different type of layout, a different type of home, whereas, whether it's apartment buildings or homes built 80, 90, 100 years ago, they were built differently, lower ceiling heights. People were smaller back then, right? And just the way they interacted within the home. So I'm just curious, do you think that could be a factor why there's more limited?
There's new home builders coming out with different models and modular homes, and due to the affordability issue in the country, small people are living in smaller homes for affordability. I think the shortage of supply, though, it traces back to financial crisis. When we pre-2008, 2009, what prompted the financial crisis? Subprime lending. Yeah. And we had a glut of housing inventory. I mean, everybody and their mother was a home builder, and clearly that's what catapulted the financial crisis. Now, a ripple effect of that is that credit was tight after that period of time, and there was a notion that we had an oversupply. So we had a prolonged period of time where there was not enough housing development, where we're paying the price rent today. You had a good decade from the financial crisis till the boom that took place, during COVID, that we didn't have enough supply being created because nobody could have anticipated this level of demand. And that's really the bottom line of why we're in this boat.
Interesting. I mean, I guess I'm just trying to think, like, what major factors could, provide a paradigm shift? Because it seems like, whether it's drastic rate cuts or something, some kind of black swan event could affect it. I mean, are there any type of factors that you see that would kind of change the course?
Right. I mean, look, it's really rates. We can't predict the black swan event. Who would have ever thought the pandemic? My favorite line is shut down for 2 weeks, shelter in place, and then go back to reality, right? Like, it made the most asinine statement of all time. 2 weeks turned into God knows how many years. Where you do have, I think, where you're going to see an impact. We're a couple of days away from an inauguration. And, obviously there's no secret that, incumbent President Trump and Jerome Powell have butted heads for years, right? And there will certainly be pressure on Powell to bring down rates from this current new administration. However, the Fed rate doesn't necessarily have a direct impact on mortgage rates, more so the 10-year Treasury does. How do you get the 10-year Treasury to come down? Inflation and spending. So we've had a gross amount of government spending in the last number of years, which is probably obviously the biggest factor for the inflation world we live in. Inflation stats are coming out positive, right? We are bringing down inflation in terms of what the projections were or the whole targets were. And if we can bring down spending, control inflation, that should bring down rates. And rates come down to a healthy level. Like, I don't think we'll live in a world where we see 2-3% ever again. Could we live in a world where we see 4.5 to 5.5? Yeah, I think that's a reasonable target. Is it, this summer, or is it summer 2026 or 2027? I don't know, but I do think that we will get there again. When we get there, it'll be pandemonium, right? Things will take off. The market activity will be insane. People will start trading again. It'll help every aspect of real estate. And honestly, that is the only solution. We have to get there, right? Like, we can't continue this way. So, my hopes are, that sooner rather than later, obviously. But I do think that that is, what we should see in the next 6 to 18 months.
Obviously you have government spending, which was very high, but also the consumer was spending a tremendous amount.
Oh, yeah.
So I think, a lot of it was borrowed on credit cards, and there was a lot of debt. But I think hopefully with some rates coming down over the next 12 months or so, you might see a slight easing, of some of this, massive spending. Even though borrowing costs are lower, it's counterintuitive. But you have to think that people start maybe investing again, or reinvesting. So, look, I think they say nobody has a crystal ball, but in fact, on the show, the Midtown View, we do have a little crystal ball. So I'm asking my guest, if they could if you just kind of feel the kinetic energy, what do you think might happen for 2025 going forward?
So I'm optimistic moving forward, and one of the major reasons is look how much wealth has been created in the last 5 years. The stock market is at all-time high. It keeps continuing to rip and hit record levels. If you look back, during Trump's first administration, the S&P doubled, and then it obviously had a catastrophic plummet during COVID. And if you go back from the beginning of COVID till today, the S&P's tripled, or close to it, not exactly tripled, but pretty close to it. A lot of that creation of wealth is real estate is a direct beneficiary of that. People start investing in real estate, they start diversifying, they start buying homes, they start buying buildings. Real estate is definitely prospers off of that. So I think when you have, that level of wealth on the sidelines, and we have hopefully a new administration that actually helps in terms of cutting government spending and bringing down rates, I think then the future of real estate is extraordinarily bright. I think our runway will be a tremendous runway for the next 10 years, minus a black swan event taking place.
Right. That was awesome. Thank you for that. Just for our viewers, where can people find you?
We're in Midtown Manhattan if anybody wants to meet in person. But we can be found on our website, romerdebbas.com.
Yep.
You have all our bios, all our contact information is there. Social media is for the law firm, Romer Debbas, and my personal one is at Pierre Debbas, ESQ.
Great. We'll put that in the bottom of the video. and make sure you like, follow, share, and appreciate you being with us today. Enjoy your view.